We think China is potentially a very big problem. China is about 15–16% of the global economy, and it's obviously the biggest market for a lot of commodities. I think they've got a tremendous problem with growth and with the credit bubble that they've seen in recent years. So I think there's a serious risk that if they mismanage it, you get a big slowdown. If that happens, it's going to be very problematic for a lot of the regional economies. Across Asia, most of the economies supply about 5% of their GDP is exports aimed at the domestic Chinese economy. And then, of course, you have the commodity makers, exporters as well. Australia, Brazil, these sort of countries could come under a lot of pressure if you start to see slippage in expectations for Chinese demand. So I think, to me, it's probably the biggest risk in the global economy at the moment. I think the two biggest global macro risks are the exit of the Fed from a zero interest rate policy. That maybe takes a couple of years, but I think as they communicate the exit, it could cause some choppiness in liquidity flows in emerging markets. India is not that exposed to this risk compared to some of the other emerging markets in Asia because it's a less open capital account, it's a less open financial system. The China risk, again, India is less exposed in terms of the proportion of its economy which is trade with China compared to, say, Malaysia, Korea, Taiwan, these sort of economies. But I think China is the second big risk that we would look at in the global markets. And aside from that, you simply have the individual country risks. And I think the striking feature in the last few years that India really has been driven by the domestic economic and domestic policy risks more than being driven by global economic environment. Well, crude oil has been incredibly flat really for the past 3 or 4 years. It's been tracking along about $100, $110, give or take. And I think you have the constraints of the promise of a big increase in supply coming out of US shale. I think you also have the diminished risks in the Middle East. So I think the risk of a real big spike in oil prices is quite low. So we see oil as being a fairly benign impact on global growth. We're rather negative on gold. I think as the global monetary policy heads towards a tightening, heads towards an exit over the next 2 or 3 years, then I think that inflation risk premium that's been built into the gold price will continue to erode. And of course, we saw that fairly spectacularly last year. But I think that's still got a long way to go. We think equilibrium prices for gold are probably somewhere below $1,000. So it's not going there anytime soon. But I think as a medium-term target, people should have in mind the idea that a normalization of global monetary policy implies a normalization of gold prices, and that's probably somewhere near to a $900 target.